The win rate wasn't the problem because, like we talked about, after you build like a library of things that usually it has a high probability of happening in the market, your win rate goes up like 80-90%. But it's what happens to those 10% you lose that usually take out the entire weeks of profit for me.
Welcome back, everybody, to Be the Trader. Today, I have a very, very special guest. I know I say this every single time I have a special guest, but this guest is someone that I really, really care about. She has never met me before, but I've met her and watched her videos for quite some time. It is Shay, aka the Humble Trader. Shay, welcome to the show.
Thanks for having me, Alex. What's up, everyone?
It's a pleasure to bring you here, Shay. I mean, the reason why you're here today is, like I said, I discovered you. And when I found you, I was like, wow, here's someone who is trying to do things different and who's trying to shed a real light, kind of a peek behind the curtain, if you will, and just trying to give back as much as possible, which is something I'm fully about. And I just love that you're about that and you've been doing such a great job at it. So if you could start off by just telling us real quick, what got you into this world, and then we'll just take it from there.
By this world, you mean this crazy world of trading, right?
Yes, trading, absolutely.
Right. So I started trading, from, obviously like most people seeing those ads popping up on social media, on the internet. That was probably around 7 years ago, right out of college. So, out of college, I already had a job, and luckily I had some money, around leftover from my, paycheck, to kind of play around with. And when you're young, I was probably like, 20, 21. When you're young, you kind of just, like everyone else, you want the fast money. For me, I was really into those music festivals. And buying the stand, yeah, and then and I had the money to buy the lower tier tickets, but I really wanted like the VIP where you get a nice bathrooms, like EDC and like Ultra. Yeah, and those are expensive. Those are like $1,500 for a 3-day festival. So that's really like the first motivation was to really like to have the extra money to be able to pay for those more extravagant things. So that's what got me into it, into trading. I saw the ads. I, like you, Alex, I bought a lot of those courses, DVDs. And then, I'm not going to say they were completely useless, but they paved like the foundation, like the bare minimum basic you need. But it definitely got me hooked into trading, even though, I wasn't promised like the Lamborghinis within 6 months, but I'm still glad it happened and got me into trading and started. You kind of have to be a little bit crazy and passionate about this to kind of stay in the game for so long and to like stay consistently losing, but you still want to wake up every day to trade. You kind of have to be a little bit crazy to do this, I think.
Absolutely. And I 100% agree with you. I mean, we talked a little bit before the show how it's like a little bittersweet. Like, these ads got us involved. But however, I agree with you. It kind of builds a foundation, but it didn't really give you the full picture. At least I kind of personally feel that way. Now, I'd love to know, whenever you kind of discovered trading, what was the first step for you? Like, you bought your own courses. I get that. But like in terms of trading, what was your edge, or what did you find that you were attracted to at the beginning?
At the beginning, it's always the penny stock breakout. I think everyone went through those, buy at $1, sell at $2, buy at $2.50, sell at $3, stuff like that. And I did that, and I was following chat room alerts. Like I was going from like chat room to chat room, the $20 ones, the $50 ones, the $100 one, the $200 one. I was just looking for alerts. And then when one chat room didn't work, and I'll move on to the next, thinking that, the problem is the chat room. It's not me, right? The problem is I need to find the right chat room. And unfortunately, I think a lot of people are still going through that. And I think it's actually like a very, it's like the foundation of any trader's journey to kind of learn how not to trade. So I think it's still important to go through that. And it sucks to have to like do that, going through chat room circle to circle. But I think that's still very essential to learn how not to trade. So I did that for a while.
How long was a
So
while?
it's still useful, kind of, I think.
No, how long is a while? And give me an idea of how long that part was for you during your journey, and then how long did it
Sure.
take you to find, your own kind of consistency. And consistency could just mean
Mhm.
just like baby profits, but consistent. You know what I'm saying?
Yeah. So the entire first year, I was all
Mhm.
red, deep in red. Like, I was down maybe $10,000. And the second year is where things started to, I'm still losing overall, but things started to make a little bit more sense. And then I slowly made back to break even after year two. And
And then
third year was my first ever green year where I can say, oh, I'm actually making money on the third year. Yeah.
nice. And what was that for? What was the switch for you? I mean, if there was a switch,
Mhm.
like, was there something that kind of made you discover, now I can be that helped you get to break even and that helped you get to profitable?
So the most important thing is stop following chat room alerts. That's the first thing that changed anything, right? Even though it's not significant change, I stopped relying on other people to tell me when to buy and sell. That's the most important part. I was still in some chat rooms that just tell me the news, what the news is, and the tickers, and then I'll take their watch list, right? The tickers and the news, and I'll actually take a look at what the news are and take a look at my chart and start planning it out. So I think that's another thing. So planning out my own trades and then finding out, okay, whether this one's worth the risk or not, and filtering out because they give you like, 10, 20 tickers, right? So I'll
Yep.
take a look at the top 5, right? That kind of suits what I think is going to work, and then what the risks are for those, and then planning out the levels. I never used to draw my own charts. And then after I started planning out, I'm like, oh, wow, like, if I plan it out, it actually has a higher probability of working. Surprise.
Absolutely. Yeah, surprise, right? And it's crazy. I love that you said that whenever you start planning out your own trades and drawing your own
Mhm.
lines, I think what you're really saying too is, and correct me if I'm wrong, is you kind of start to develop your own confidence, right? You start to develop your own
Mhm.
confidence in what you can do. Because even if you're a new trader listening to this right now and you're listening to Shay and you're like,
Right.
I draw my lines, or you don't draw your lines, you should, because if you start drawing your lines, then you at least start
Mhm.
to see them work or not work over time.
Yeah.
And you can see what you need to improve on. I'm very curious on people who are listening right now, Shay, and they hear you say, I stopped following chat room
Mhm.
alerts. They're probably scared, like, well, I don't know what to do. Like,
Mhm.
how did you overcome that fear whenever you were like, I'm following chat room alerts, and how did you jump from forget these chat room alerts?
So I'm even though I was still in the chat rooms, I would stop looking at the entries and exits. But I would look and read through the commentaries that some people are talking about. Like, why do they think biotech phase 3 or phase 2 is a big deal? The actual breakdown and the reasoning behind why people are going into those trades. I think that's more important because you see the tickers may change, but you see the same charts and the same catalysts all the time, right? Repeatedly with different companies, different tickers. So that's where you start building a collection of database of, the what you might call it, like the things that tend to work, that has a high probability of working. Let's say FDA approval. In the past, I've seen it sell off 8 times out of 10. So in the next time, I can make a calculated risk saying that, okay, it's probably going to sell off, right? So it's the same idea. You start seeing the same thing, same situation happen with similar stocks, similar catalysts, and you piece the tickers and the fundamentals together, and then you look at the charts, you start seeing the same thing happen, repeat again, time and again in the stock market. So that's where you kind of start building that knowledge base in your head, in your brain. So it's not about the pattern or whatever, like the buying the breakout pattern. It's not so much about the pattern anymore. It's about everything else behind the tickers, the companies, the float, the fundamentals, what the daily chart looks like. You start building that library in your head, and I think that's what we call screen time and experience in trading. And then you start saying the same thing, and next time, while you're never 100% certain it's going to work, you kind of remember, oh, stock ABC did the same thing last time, and the chart looks similar. So last time it sold off. So maybe this time I want to go short.
Hmm. Yeah, I
Yeah.
agree. And screen time is that's why they say, I mean, you want to survive. You want to trade long enough to survive so you can start to like learn and then eventually thrive, right? So
Yeah.
I want to know something. You mentioned something earlier about you mentioned patterns. Now, I've been
Hmm.
following some time, and I know you're more focused, and correct me if I'm wrong, but I thought you were more focused on more of the, not so much patterns, but more so
Hmm.
psychology behind
Hmm.
the setups themselves. Can you explain a little
Hmm.
bit about that?
So, you know, I trade mostly the setups, and what the psychology is behind it. Patterns, I believe, are those, bull flags or bear flags or whatever. Like, when people mention that to me, I never know what they're talking about because I never really studied those chart patterns. But the psychology behind it is more important. Like if you look at a daily chart, even if from like a technical standpoint, if there's a gap on the daily chart, something must have happened that caused the stock to sell off so drastically. So the next time the stock approaches the same level, if you can think about it from a psychological standpoint. The people who were holding the stock, from that point before the gap, probably will want to sell, right? And the same idea, if a stock gapped up overnight, 20, 30%, 2 points, $3, then you can imagine it to sell off first because, if there were investors, there were people, there were algos loaning the stock overnight and you made a 20% gain overnight, you probably want to sell to take profit. So it's kind of always kind of thinking about what the other side of the trade is and what collectively everyone in the market is likely to do. But even if you don't consider the psychology behind it, knowing the chart, knowing the setup and the technicals also helps a lot too. Psychology and technicals kind of go hand in hand.
I like that you said that, and I'm very curious on where are you at now in terms of
Hmm.
are you more of a technical trader? And I kind of already answered this, I think, but also you mentioned fundamentals earlier. So like,
Hmm.
do you kind of use everything, or are you like, give me an idea of what kind of trader, if you could describe yourself, what kind of trader are you?
I like the best setups for me are when both the fundamentals and the technical align with each other. So So to answer your question, nothing is purely fundamental. Nothing. I feel like I'm not answering that question. Nothing is purely fundamental, and nothing is purely technical. Like I don't think I can trade like a technical, let's say like a lower high setup, and
Okay.
make consistent profit, and just based off the technical charts. So I
But
think I need everything. I need the fundamentals. Like let's say the stock has to have earnings and beat earnings for me to want to trade this bullish chart setup.
gotcha.
Yeah, has to be both.
That's perfectly fine. And I'm very curious on one other thing, and that is, are you, how would you say, what was like the biggest challenge whenever you were trying to make the hurdle to your own consistency? What was like your, everyone
Mhm.
has like something that's like either their biggest weakness that was a great opportunity for them to overcome. Like, what was it for you?
Oh my God, it was risk management. Um, the win rate wasn't the problem because, like we talked about, after you build like a library of things that usually it has a high probability of happening in the market, your win rate goes up, like 80, 90%. But it's what happens to those 10% you lose that usually take out the entire weeks of profit for me. So it was definitely risk management because nobody likes cutting your losses, right? Taking a loss, you always think, oh, it's gonna come back, or if you're short, oh, there's a penny stock, it's gonna go back down to $1 after a couple hours, and it was definitely, risk management is the toughest thing to do, but it's the most necessary, I think, and also same as planning your trade. So started having max loss per trade and max daily loss as well. And also, I started having this rule of if I'm red on let's say day one, the second day, if it's a big enough loss from day one, then I don't trade the second day. And second day, if I'm still trading, then I'm aiming. I cut my size by half, and then I do like base hits. $10, $50, anything to end the day green is fine. So I think that's the risk management part. Yeah.
I love that you brought up risk management, and I'm curious on when people are hearing you say, "Well, I just had a
Hmm.
red day, Shay, and now you're telling me to go half size." Like,
Hmm.
that's like, how am I gonna make my money back? Like, like, what do
Right.
you say to those people?
You shouldn't focus on making your money back, right? That's what I do for me. Like a lot of times, I'm surprised I make my money back on the second day. So because I'm cutting my size, because what I want more is my confidence back, right? I want my confidence back. If you think about your P&L chart, like on your own P&L curve, it's okay to have pullbacks, right? It's like a stock. It's okay to pull back and consolidate to go higher. You need to do that as a trader psychologically. I think most times if I focus on just, I want my $5,000 back or whatever, I tend to lose even more. So for me, that doesn't work.
Yeah,
I'll
no,
be down like $10,000-$20,000 the next day. I don't want that.
absolutely.
Yeah.
And you mentioned something like you implement a max loss per ticker and a max loss for the day. Can you explain for someone, you can use generic numbers like let's just say someone has a small account, and just so someone can relate how you calculate that, could you explain that?
Sure. So let's say you have a $5,000 account,
Mm-hmm.
and let's say you lost $100 per trade. I think that's a big enough loss for a small account. $100 per trade, per ticker or per trade. I think your max loss probably should only be on the day, probably no more than 200 if you're trading a $5,000 account. And to be honest, down $100 is already too much for a ticker. I use a calculator that I use to calculate. So, I think the maximum you should risk for the day, like a max loss for the day, should be up to 2% of your account size. So what is 2% of $5,000?
I'll tell you off of calculator because we're all bad at math. $50.
Yeah,
$50 is
well, I don't
1%
do
and
math.
2% is 100.
Okay, so that would be your max loss on the day. Again, it sounds like people are like, oh, what? It's only that's so little, but for your account size, I think that should be the max loss on the day. So your max loss per ticker probably should only be $50.
Mm. So
That's what I think,
basically,
anyways. Yeah.
if like your max loss for the day is 200 or 100, and your max per ticket is 50, so really, are you implementing, if someone's trading, what is your thoughts on the idea of I go $50 per trade loss minimum? Like I'm going to size in $50 per trade. Like, what's your thoughts on that? Is your opinion on that idea?
I think that works. I think that's what I did though. First of all, when you pick to go in a trade, if you're risking $50, your trade should at least be able to give you 150 or sometimes $200. On these low float stocks, it's very possible. The risk reward is really good if you have the right setups. If you're not buying breakouts, first of all, if you're buying consolidation, a lot of times the risk reward you can get 1 to 3 or 1 to 4 or even more, especially if they squeeze with high volume. So I think it works. You have to be very selective about your trades. So like you have to make sure and playing it all out. Okay, does it actually can give you 3 or more? If not, then you don't take it.
So are you saying, are you more of a believer on like a 3-to-1? Like, do you have a rule for yourself? Like I only trade 2-to-1, 3-to-1, or are you flexible in that?
Nowadays I am, but I think in the beginning stages where things like you have to be very strict in the beginning. So what we talked about year 2 and year 3, I was very strict about my trades, and I'm not as strict anymore now. But back then you have to be, because you have to. I don't have PDT rule in Canada, but imagine if you were in PDT rule, it's even more important to focus on just 1 or 2 or 3 trades. That's actually gonna give you the risk reward. I think for the more experienced traders, they can take trades for scalps that's 1-to-1 or even just 1-to-2. But I think for newer traders, you want to aim for 1-to-3 and more.
Awesome. And
Yeah.
what was it for you though? Because you were working at the time and trading, right? So like,
Yeah.
there's people listening to this and they're like, man, I'm working and I'm trying to trade. Like, what should I do, Shay? Because I'm sitting here and I don't have time to day trade like you do. It works out
Right.
for you because you have time now. But well, wait a minute, guys. Shay was working too at the time when she first started,
Yeah.
and she traded part time. So Shay, can you
Yeah.
explain like how it's possible to be able to do that?
So I'm on the West Coast. So the market opens at 6:30 a.m. here. And I used to wake up, 4:30, 5 o'clock. I'll plan out the trades. First of all, plan it all out. If not, usually I prefer to trade the stocks I planned out the night before. But if not, then I'll plan it out pre-market and I'll trade the open the first an hour and a half. and then I'll get to work late. Yes, I have to get to work late. Not suggesting you to do the same, but I was always late at work. I was supposed to start at 9, walking at 9:30. Don't do this at home, kids.
You talk about planning your trade. You mentioned at the beginning of your talk too as well, and then you brought it up now. What does that really mean when you mean plan your trade? Like, does it mean just like, I see something that's moving an hour before and I just jump in the trade? Like, can you give an example so for those who are listening, like what that really means?
Sure. So I'll do the evening planning. So the evening planning will be the night before. So after work, like I come home at 8 p.m. local time, and I'll plan my trades. I'll look at what are the top gainers on the day. So could be the stocks I missed, could be the stocks that showed up midday while I was at work, and I'll look at it. I'll take a look at the fundamentals. What the catalyst is. And if you look at the stock that held the gains the day before, usually it's gonna be a large caps, right? The large caps are gonna be the ones holding the most. And truth be told, the large caps were the more consistent setups for me in the earlier second or third year. So I look at the large caps that held the gains, and then I'll plan for continuation, because the large caps tend to trend a lot more than the small caps. So I'll, a lot of times these large cap, red to green moves will be the ones I plan out for the second day. The next day I'm gonna trade. So I take a look at the levels, which are the key levels I held on day one. And I'll take a look at how strong it closed how strong it closed, whether it's gapping up after hours, that's gonna change my decision making for the next day, or whether it actually sold off near the end of the day. So those two things were really important. As for the small caps, they used to do more continuation, so you used to be able to do more, similar setups as a large caps, but in 2020 they are not really doing that. Yeah. Small caps, they are not holding as much.
No, they're not. And it's very interesting that you said the beginning you were focused, you found more consistency on the big caps, and now it seems like you're more primarily focused on small caps. Why'd you switch? Like, what was up with that change? Because I'm going the opposite. Like, I'm switching to big caps. Like, I'm slowly going to big caps now because I'm loving that there's opportunity every day on big caps, like every single day. Like, and so that's where I'm leaning towards. So I'm just curious on like, why'd you go the other direction?
Actually, so it used to be, small caps would actually die and stay like the entire small cap market would be dead for the entire summer. So it used to be because I need to survive, right? Even when I was trading part-time in the summer, I see a lot of other traders blowing up in the summer because there's no small cap movers, right? They are just forcing trades. I used to do that for a little bit, but then I realized, okay, I need to kind of adapt and focus more on the large cap. So that's what I did, large cap and small caps, depending on the market sentiment and depending on which sectors are actually moving. And I think in 2020 is really the year I look at my stats. I'm like, holy crap, I'm trading mostly small caps. But this year, because I think this year, everyone will say the same. This year, small caps have been crazy. I think the big caps too, but small caps were really consistently active even in the summer. So I actually I trade them side by, like you kind of have to have a left brain and a right brain when trading a small cap and the big caps. But I would say, unless there's something very good setting up in the small caps, I still prefer to trade the big caps, unless nothing is really happening. But usually, if you look at the trades I do, I usually have at least one or two big caps amongst the small caps. Yeah, I still trade them. Like last Friday, I did trade PLTR. Yeah. So I still trade both. Yeah.
Okay. And so what do you mean by you need a, I know you, what do you mean by like, you might want to have like a left and a right brain when you're trading big caps and small caps?
Yeah, because they move very differently. Large caps, they tend to follow the technicals and the support resistance a lot better. And they trend a lot better, right? So that's what I meant by a lot of times you see the actual follow through on the second day and the third day and the fourth day. But small caps, if we're not counting the sector it runs, the small caps a lot of time is the 1 day and 2 day instead. So they don't trend as well. And also small caps, like big caps, once they reverse, let's say, it was really strong, they reverse and sold off, they tend to stay weak. But small caps, you can have it spike and dump, and then it just looks dead for the entire day. And then power hour, all of a sudden they spike right back up.
Yeah.
So I think small caps are more random and more like bipolar. It's like that bipolar chick that you don't want to miss. You don't know what she's going to do. Like, are you going to scratch my car? Or are you going to send me flowers? I don't know.
Yeah, no, I totally agree with that. I totally agree with that. And I think it's why I'm starting to love big caps a lot more because they're more reliable.
I agree.
Easier to see, easier to, to wait for, the setup is a little bit more clear. You said they tend to trend better, which I agree.
Yeah.
They trend a lot better.
Sure.
And granted, like if you're listening to this, you're interested in penny stocks, you're probably interested because the same thing that me and Shay were interested in. We wanted to make that big money real quick at first, right? But just to know, like you can make good money on big caps too. Like you can make good money. You don't have to trade big size. These big caps still move. Like they still move several points in one day. And so I agree with you 100% there. You said adapt and market sentiment. Can you explain how this year, how you've been adapting?
So this year I have this rule of if a stock is trading 5-10 million pre-market, then I'll be more careful on the short side, because this year I was taking a look at my stats. All my more significant losses are from shorts. So I think this year has been difficult to short. So and I have this kind of implemented this rule of okay, in the previous years, if I was gonna short at 100%, this year I'll wait for that 200% to short and go long, around the 100% area.
It's so funny you said that.
General, but you have to be careful. Yeah.
Yeah, you do, and it's wild. If you're new to trading, like if you just got into trading in 2020, like you think this is normal. Whereas I know Shay can agree. When I heard you say, when I see a stock trading 5-10 million pre-market, first off, that used to like never happen. And now, I mean, what was it for like a couple of months? We had some stocks that were trading, no joke, we had some pre-market trading 50-60 million pre-market. And I was like, what is going on? Like we had 1 billion shares traded on one other ticker. What was it? I don't even remember, but it was a ticker that traded 1 billion shares not too long ago. And that's just
Evo.
Yeah, I think you can say whatever you want. And I'll be like, I don't remember.
Okay.
But I definitely know it happened. I was watching it and I was like, this is wild. And it's just crazy how the market's changing. And I think you're really relating to when you're saying 5 to 7 million pre-market or 10 million is float rotation. Because I'm a short seller mainly on the small caps. And on small caps, I've noticed that my setup, I love shorting like the gap and craps, up, significant. And they've been a lot different this year.
Yeah.
Especially the last half of the year. They've been way different. And and you can take a lot of losses. I've know people who've blown up accounts who've been very well at trading because they didn't want to cut their losses, which is something Shay talked about at the beginning. One of her biggest challenges was risk management. That's why you need risk management, so that way you don't blow up. So Shay, I'm curious, when you say market sentiment, what do you actually mean by that? Because some people might hear that and have no clue what that really means.
If we're talking about the small caps, right, the sentiment would be, sometimes, like we said, the stock will be up for a day and the second day just gaps down. So then you can say, okay, the sentiment is, the second day is the day you should short. And the first day, you maybe only want to short the parabolics and you want to long the consolidation, right, the steady grind up. But if we're talking about like the electric vehicles, the entire sector, every day they're just, some of them pull back now, but a good chunk of last week and the week before, even the small cap electric vehicle stocks, they were just going up higher, higher, higher. You can see when after they have the sell off candle, I think, what was it, Solo? Like before 10 o'clock, it sold off. I was like, okay, yeah, it's dead. No, it just steadily go back up. So I think it depends on whether you see it consistently that every day they're saving these small cap stocks. When it looks dead, they actually slowly grind back up. And that was the sentiment for a good 2 weeks. So it's just kind of observing what's been happening, whether the weakness is being bought back up or whether the strength is being sold into.
what someone's going to hear this, and I get this question all the time when we talk about markets. They say, well, when is something significant enough for you, Shay, to be like, oh, I need to start trading this way now with this type of instrument? Because it may happen once, twice. Like, what is your idea on that?
Usually, if I see in the same week, if I see something that stands out happen 2 or 3 times repeatedly, then you can usually that it could be the algo spike, the fake holds or whatever that we're seeing, or the holds that just goes 200%, 300%, 400%, like KXIN. That happened to a couple of different stocks. If you see the same abnormal price action, let's just say that 2 or 3 times, then you have to be careful, right? So that's when I would say, okay, this is what's happening in this market. Usually it's like within the 2 weeks period for the small caps, because they change so fast.
They definitely do. And so basically, if I'm understanding correctly, like if you're trading, this is just made up stuff right here, guys, but if you're trading a setup that typically just gaps and then dies at the open every day, and then all of a sudden you start to see some weird, just abnormal behavior after a couple of times, then you're saying like maybe you should take that into account and maybe adjust how you trade that setup.
Yes.
Okay. Perfect.
Yeah, and then I would actually go even further, and this is where the homework comes in. Actually going even further, and after hours or whatever, take a look at the 3 stocks that show the abnormal price action, and take a look at what they have in common. Is it the sector they're in that are they all biotechs? Are they all electric vehicles? And what's a float structure like? Like take a look at what they have in common. And that's how you collect those data points in your head that you can reuse later on when you trade the similar stocks. Maybe it's a float. I don't know.
Yeah, no, I love it. You said that. That's if you listen to that, rewind it, because that was some great added tip that Shay just threw on you guys. And Shay, before we wrap this up, I just want to ask you 2 questions. The first one is, if there is a market stock related book or an unstock related book that you read in the past that really helped you in your own journey, whether it's specifically around stocks or not, what would that be?
Atomic Habits by Mark Henson. I forgot his last name, but his first name is
I'll
Mark.
post it. Yeah, I know Atomic Habits. It's a great book. Is there something that sticks out from that book?
Oh yeah, it's about discipline and how to trade, how to create the right habit for you, and how to create an environment and habits that sticks. Like all the discipline and the risk management side, especially, it's something that you have to very intentionally create those rules for yourself, and whether you follow that or not, it comes down to your habits. You have to build a habit. That's what I learned from the book. You have to build a habit for yourself, environment or conditions or a series of steps that you have to do to make it favorable for you to follow those rules, to stop out, to follow your risk. So I think that's more important than all those setups and strategies, because those have to change. But your discipline is what's gonna keep you alive in this game for the next 10, 20 years.
Amen. I agree with you 100%. So if anyone wants to learn more about you, where can they find out more information about you, Shay?
So you can find me on YouTube, Humbled Trader, or you can find me at humbledtrader.com.
Perfect. Well, Shay, thank you so much for being here today. Again, it was a pleasure to have you on the show and an honor. So thank you so much.
Thanks for having me, Alex. And thank you everyone for watching.